So I reduced the number of hallmarks, okay? And I used to like having there just too much. I'm getting nicer in my old age. Well, I'll skip the market updates for right now because, but there's a lot going on in the global markets. I mean, the trend in the 10-year Treasury is starting to drop significantly, so the inflation trade's over. I don't think everybody's come to the realization Trump's not going to get a lot of this stuff done. Okay? So basically, the 10-year is starting to rally, along with other interest rates too. And then you got the Brexit with Theresa May. That was positive, along with the announcement that she's going to call an election for June. So that was positive. Obviously, North Korea is a big issue for Southeast Asia. Hasn't really affected the United States, but may have had an effect on the 10-year Treasury yields coming down as capital flight comes in because people are freaking out of what's going on there. They really haven't started the negotiations or renegotiations on NAFTA yet, so that's something to watch, and the impact on the peso and Mexican companies. There's lots going on in South Africa under Zuma, political instability. Be interesting to see what the Rand's doing right now and what the stock markets are doing down there. Probably a lot of volatility and depreciation. And then Brazil, still in a basket case. Political instability, recession. You know, this was one of those emerging markets that was in really good shape. So Argentina seems to be coming around. They went through a hyperinflation bout, but they seem to have stabilized and started to recover. So that might be a play for you guys there. And then Brazil's still the questions out on Brazil. So the memos and the reports, let's keep working on the GTC reports to get those things really tightened up, you know, as a investment brief, so that if somebody asks you, have you ever done an investment brief before, you can give them the report that you know how to do that stuff. And then the market memos, start giving me those memos. Some of your memos still aren't, you know, at very high quality. So you need to be working with me on those memos. Okay? And again, everything's global. I would like to have the one-page stock market report. You have an emerging market, and then you have a major market stock market report. And then I want to do 2 bond market reports. Same thing. Okay. So again, these are nice little briefs that you can show people that you know how to put together some really quick one-page reports. I do want to do the peer-reviewed journal article. Okay, so I gave you some dates to shoot for on that. I really want to do the peer-review thing. So pick either international stock or bond diversification, foreign currency, you name it, you pick it, something you're interested in, read the article, make sure it comes from a reputable peer-reviewed journal article, and focus in on, you know, what the summary or the abstract is, what the problem was, with the data that they used, and any filtering or massaging they did to the data, what was the model type that they used, what were the results and what were the conclusions, and then I would make a recommendation on your part on how to use that information to be able to commercialize it within our company. Because the academics are great at doing this stuff, but they're really bad at commercializing their models and their stuff, unless they're tied right into Wall Street or some other type of product development firm. Deliverable 2 is due on the 28th. Give me the cover, give me the memos again, I want to see those. The final exam, which we're going to talk about. Homework 2, which I scaled back. And then the one-page emerging stock market report. Okay. And then the resume. And if you need some help on the emerging stock markets, I got a bunch of books over there that you can peruse through to get some ideas, but you can pull the information from the web pretty easily. The in-class midterm will be next week. I'll go over the developing stock markets. I've already provided you, I believe, the reports, so they're already posted. So I would just start studying those. And then the factors driving foreign direct investment, that should be pretty easy. That's all I want is, hold on a second. I made you copies of the exam. Made you copies of the exam. So you can just, it's a worksheet, all right? Yeah. So a bunch of copies, okay. So this should be pretty straightforward on how to fill this stuff out, okay? Yeah. then on the exam, on the multi-asset portfolio, there's a section right here. This is where you do the graph. You've done the modern portfolio graphics before, do it again, but do it in a global context and give you the global portfolio. I just want to continue to test you on it, but you know that when you build the global portfolio, it bows out the efficient frontier. And you can also bow it out by using the derivative contracts on your exposures. That's pretty straightforward. And then this global stock portfolio construction, what I did was I also made you some worksheets, okay, that you can sit down and just go through it. What I would do is probably, here, so I give you an extra copy of the worksheet, okay? So you can rip off the first page. I know it's double-sided. Let me know if you need more worksheets. So what I did was I basically built you a worksheet. Right? This is basically the underline of the fact sheet. So you just work through the worksheet. We worked through the worksheet last week, right? When I did my own portfolio. So I went through it, what did we use, GDP as the weighting factors? I mean, again, you could use an FDI or an export weighted. I mean, GDP is pretty straightforward. I'd be a little bit more creative. I think FDI is a pretty good weighting metric, which won't concentrate the exposure into the biggest markets. You know, they will have if you're using a different metric for your portfolio style. Okay, an FDI and export-oriented weighting would be pretty cool because everybody does GDP and everybody does market cap. Okay, so you're trying to create a different style to attract the capital from the investors. And then again, you just work through this worksheet. And then again, it's pretty exhaustive. It drills down, but again, we went over it last week. You guys already started yours, right? Using country ETFs. Somebody else could use country mutual funds, depending on how you want to do it. So you do a fund to fund, that's probably the easiest way to do it. Okay? So we can work through this a little bit later, but I provided you with the worksheet. So what I would do is work through the worksheet and then transfer the data over to the master worksheet and then hand that in to me with the deliverable. Okay? Any questions on the global stock portfolio? The thing that I'm really going to be interested in is your expected return on the portfolio and the alpha you're going to be able to generate, if you can, from the portfolio. Right? Isn't that really what the investors want at the end of the day is alpha? Yeah, so you're going to have to pick a benchmark, right, to compare it against. And if you got, I don't care if it's 5-year or 3-year or 10-year, just get enough data from the funds that go back far enough across all of them to be able to calculate a weighted average expected return for the portfolio. And then I would go ahead and do a weighted average beta and calculate a risk-adjusted return using the beta, okay, as opposed to the standard deviation. Because the beta will be easier to get from the documentation from the reports, okay? So give me for the portfolio construction, if you can, give me like a little mini write-up on it, so 1-page brief on it. Give me the worksheet, okay? And then if you have any supporting material, I'll take that too. If you want to show me samples of the country funds that you use, just the fact sheets, you know, or the ETFs, because I'd like to look at them too. Okay, I think it's really, really interesting. And then don't forget, you have to have in here that I included your final pitch. You're going to be sitting in front of an institutional investor. They're going to say, well, you know, I got 5 meetings today with five other guys like you. Why should I invest in your fund opposed to the other ones? So you got to give me that 2-sentence, you know, pitch that will grab my attention. That will cause me to basically do more due diligence and then give you the $22 million to invest.
Is that pitch like more detailed than the recommendation, or could you just restate your recommendation again?
You know, ours is a foreign direct investment fund. You know, we're investing in ETFs. You know, we believe our allocations by country, sector, and individual companies will outbeat the market benchmark by at least 300 basis points. You got me. You know, with moderate risk. That's it. I mean, that's kind of what I'm looking for. And if you can even drill it down even more, because even that might be a little bit more wordy than it should be. Just give me that sales pitch, okay? Because that's what we do. We constantly are selling stuff, okay? Any questions on that? You know, did everybody get a worksheet and everything? Okay, so you got the midterm and you got the worksheet, right? Okay, I just want to make sure everybody has it. And then for deliverable 3, which is the final, and I actually already printed out the final stuff too, and I'm still kind of working on it. I'm not going to give it to you right now because when I give it to you guys, it goes into some black hole and then you end up finding it underneath your bed, you know, like a week later. So I'm trying to ration this stuff so it doesn't get lost. So deliverable 3, cover, give me the market memos, let's get those things done. I mean, we should be done with those by now, right? The stock bond market briefs, you guys can allocate that. You've already done it before. Give me the GTC report also. This is going to be your final portfolio package. So I want to assemble everything so you have it all in one place, right? So that when you walk into that interview, you start talking about stuff, man, you're giving them examples and, you know, blowing their minds. And then homeworks 3 and 4, I reduced those down too. So I just scaled it down. And then I'm going to ask you about Kyle Bass. I think I already sent those questions to you. They should be pretty straightforward, 20 minutes of the video going through. I should be able to do that in like 30 minutes, I hope. Business government relations questions. Again, I'm going to go over it like I'm doing today with the emerging stock markets. I would take notes, you know, and then just fill out the form. So I'll be lecturing, like I'm doing today. I'll be lecturing. You got the business development questions. I'll be writing like mad, right? As I go through this and then go back and fill in any additional information in the questions, okay? So I'm not gonna make you go do a bunch of stuff, just follow along, take a bunch of good notes, and then, you know, maybe if you wanna review the video, you can review the video. If you wanna go back and take more notes, because you already have the research paper, go back and do that. So I'm really kind of moving, and I'll do some problems and stuff over the next couple weeks as we meet, but I really want to get into the strategy stuff, you know, the high level, because you'll always be able to figure out how to do the calculations, because you know where to go to get the calculations. And thinking at the strategic and tactical level, you got to have somebody train you to be able to start thinking at that level. Okay, and once you get to that level, you'll blow everybody away. You'll be in meetings, you'll be able to contribute into the meetings because everybody in the meeting will be thinking the same way, okay? And then it's just a matter of coming up with the actual calculations, and you go back and do the calculations, and then come back and do the results, okay? And then we'll do portfolio construction. So after you've done the stock construction, it should be fairly straightforward to do the bond portfolio construction. It's the same worksheet, okay? So you will have already been through it at least a couple times. So hopefully that will speed the process too. And then you have the Deutsche Bank and the HSBC presentations. Okay, I'm going to get Sarah Vattel in here as soon as possible to take us through where to go to get the data. Although, do you know where to get the data? Morningstar, yeah, I mean, you know where to go to get the data. Okay, and I'll help you out. And I'll give you, do I still need to give you examples, or do you still have examples from last semester to use as templates? Yeah, those should be in pretty good shape. Okay. And then what I'll do is I'll do a case study. I found one of my Lufthansa. What is it?
Lufthansa.
Thank you. A case study. And again, I'll just put together like a one-page, so that you used a case study analysis, and that's really the Harvard method. So when you go to grad school, depending on the school you go to, the Ivy League is totally into case study analysis. So I figured you should have some experience in the case study analysis. And I think the case studies that I put together are pretty good. I know the Siemens is really good, the Lufthansa is really good, the Kentucky Fried Chicken's pretty good, but I think the Lufthansa is probably the best one. So I'm just gonna probably use that one. And then if you wanna I probably won't test you on it, but if you want to look at comparative political economy, is look at that final exam that I did on the comparisons between China and Russia and Brazil, you know, the 4 countries, and read through that, okay? And then you should be in really, really good shape in regards to this whole international stuff. Okay, any questions? Go for it.
Did you send or post on Moodle the take-home exam for deliverable too?
The take-home, I did, and I just handed it out to you.
Oh, the worksheet?
Yeah, there's 2. There's the actual exam, and then there's the worksheet.
Okay. That's the take-home?
Yeah.
Okay.
Yeah, so you have 2. So you have the worksheet and you have the exam. The exam that you can work from is this one. And you guys can start working on that now, okay? Today, when I do the lecture, start filling it in, work through this, and you should be in pretty good shape.
And then the other pages are the take-home. It's the worksheet. The worksheet's the take-home, basically, right? This one.
Yeah, well, all of this is the take-home.
All of that's the take-home. Okay.
Yeah, this is the whole take-home right here.
This right here is not take-home.
Yeah, but I'm giving it to you now so you can work on it.
So there's no actual take-home.
Not really. I mean, this is the take-home, which is the income. Okay, does that make sense?
Yeah.
So this is it. So I would just, you know, burn through this, you know, work on it. I think your biggest challenge is going to be the case study.
And question 2 is the case
And then question 2 is your worksheet.
for the case.
Okay, yeah, that's right. So I gave you 2 copies.
Okay.
So you can work on that one instead of working on this one, then making mistakes and crossing it out, and then I get an exam that has all these markings on it, and it's like, this is the fact sheet that you're gonna get applied.
Yeah.
Okay, so I would work on the worksheet and then transfer over.
So same exact answers from.
It's the same exact, but that's just a worksheet.
Okay.
Okay, that's the worksheet. And again, where it says question 2, you don't have to do the first one. It's just the portfolio construction piece that I want you to do.
Yeah.
Okay, this is what I'm gonna study when you hand this back to me.
Yeah.
Because I'm gonna see if there's bullshit numbers in here, or did you actually think through the process? Because you asked me to teach you how to put together a global portfolio, this is how you do it.
Yeah.
Okay. Any questions?
Yeah, Professor.
Yes, sir.
For the global multi-asset and the portfolio
Yeah.
management theory,
Yeah.
I didn't see that.
That's gonna be right here. That's on page,
Oh, it's right here.
yeah, that's page, it says page 1, but it's right here, it's question 2. Okay. Do I need to go through that again? Yep, okay. All right, so why don't you guys go first and I go? And then, see, is there anything missing?
So we did this stuff as a group.
That's like the team program test, yeah.
Huh?
So if you all work together and do it on your worksheet, and then transfer what you guys all worked on over to your.
Okay. This is the same.
Yeah, you just turn that one into the case.
Yeah.
Yeah, this is it. So that's pretty straightforward. I think it should don't take much to argue this one. So let me move the camera around for you guys.
Do separately. This we just do this.
And then for those of you who need to work with me on remediating your grades from the last deliverable, come see me so I can work with you, so I can get you guys up and running. Okay, can you turn off the lights too? Yeah, keep more, because I want to be able to see the screen. Okay, one more. Yeah, hold on, I probably need to. Can you do it on the other side? Yeah, can you go on the other side?
international capital budgeting and how GTC will use capital budgeting in order to profit. James will go over the first few slides.
So GTC will profit $5 billion in 5 years, $10 billion in 10 years, and $20 billion in 15 years. And this is going to be done by investing in opportunities with a high APV value. This is different from a little bit different from a net present value, but basically the high APV value means a high profit for GTC, and it will help us better understand net present value. So a way for us in the real world right now, in order to capitalize on our APV calculations, is by taking a look at the recent Paris deal that happened in terms of climate. This deal issued subsidiaries allowing oil companies to receive tax breaks for their oil production if they agree to only output a certain amount of barrels. And so this limited production drives down supply and demand while the natural energy market is growing. And so through all this, what these companies are doing is they're using these subsidiaries and will eventually lead to a boom in their firm with the innovations that they're going to find in clean energy. And so a way that we could better evaluate these companies is not by using the net present value, but by using the APV. And the APV will be discussed by John.
Yeah, so before that, net present value, we'll learn this in BizAd 123. Basically, you want a high net present value, and to accept a project, you would have to have a net present value greater than or equal to 0, and to reject it, it would have to be less than 0. And another way of accepting or rejecting a project would be looking at the rate of return, and that would have to be greater than K, which is the WACC, and obviously if it's less than the WACC, then you would reject it. So that was the equation for that. And then this is the APV, which is the adjusted present value equation. So this is the value additivity approach to capital budgeting, which is a fancy word of saying it basically counts or terms all the discounted cash flows and all the cash flows as their own entity, and then applying different rates that are consistent with that cash flow. So in a sense, it's more accurate. So instead of going through the concepts, this capital budgeting has a lot of math, so I decided to use a case in order to explain the concepts behind it. So let's say you're a Canadian company that ships out products to Europe, and then they manufacture it and then send it back to Canada, and then you basically sell it there. So instead of doing that, you basically decide to create a project that will build a manufacturing facility in Europe. That would make manufacturing a lot faster, but not only that, you would have local presence in Europe, so that would increase profits and sales through that. So basically, these are all the numbers that the case has according to the project, and you can see somewhere right there it says that the cost of the project in Canadian dollars is 8 million or 5 million in euros. Let's see, and yeah, so that's the background. And basically the first steps that you do in order to find APV is the first one, which is the calculation of the present value of the after-tax operating cash flows, excuse me. So you would have the S, which would be the future exchange rate, and then you have the European sales, and then all these calculations like lost sales, and then the cash flows here, and then this would be the final value that you'd have for the present value of after-tax operating cash flows. So in order to increase, this is the number you want to increase, so in order to increase that, you would have to basically forecast a greater future exchange rate, or forecast a greater European sales, or greater European sales. So that would be a way to increase that number. The second calculation that you'd have is the calculation of present value of the depreciation of tax shields. And like I said before, you'd have to, this is basically the calculations for to get this final number. and then you would have to increase future exchange rates or forecast a greater future exchange rates, as well as greater depreciation tax shield number. This is the third calculation that you would have, which is the concessionary loan payments, which is this graph right here. You'd have to again forecast greater future exchange rates as well as principal payments in order to get this greater number. So you want to increase this because you want to have a greater benefit of concessionary loan payments, which is this number right here. This is the principal payment, which you would want to increase because you're multiplying that by the exchange rate, and this is the number you want to decrease because this is the payment that you'd be paying, and then that would be this, and then that would be the grand value. This is the final one, I believe, calculation of the present value of interest tax shields. Again, you would have to forecast greater future exchange rates, as well as a greater project debt ratio in order to get a greater grand value for that. And this is what you basically put together with all of the calculations. Like what we said before, the cash flows, the depreciation tax shield, the benefit of the concessionary loan payments and the interest tax shields. And after that, you would have to subtract the initial cost in Canadian dollars, which is 8 million, and you would get the adjusted present value as 487,000. And basically, if you aren't happy with that as an investor or as a company, you would do all these things that we discussed in BizAd 123, which is negotiate the price of the project, so lower this $8 million, or recalculate numbers such as forecasting future exchange rates, interest, inflation, and other tax shields and principal payments in order to get greater values for the first four numbers, and that would basically increase the final value of adjusted present value. And James will go over the recommendations.
You know, if you go back last, in this last slide, this addition of depreciation to the APV for with the tax shield. You know, that type of commission will allow us to confidently invest in companies such as Shell, Exxon, and Chevron, because right now their stocks are either plateauing or not growing at some of the rates they have in the past. So not only with some of the subsidies that they're currently receiving and some of these loans that they use to cover their operational costs, they're using these monies to invest in innovative clean energy, which right now is cheaper to produce than oil. So, you know, these subsidiaries that are given to these oil companies are so that they can still produce oil and still kind of make money off of it. And so, you know, the future is basically going to be, you know, clean energy, and companies, the current oil companies are going to be the leaders of it because of the money they're stacking away to innovate in it. So we recommend to do these following trades.
And yeah, that'd be it.
Can you go back to the second slide? And is that the proposition right there? Yeah, will you copy that and put that as the last slide too?
Last slide.
Yeah, you want to hit us again on the end of that. And then my only last comment was that was a great presentation. I mean, really good, very professional. You guys took us through all the economics. I mean, it was great. The other thing that was great too is when you were showing me the that one slide, and you can go to the second to last slide. That one. When I was looking at that slide, I was going, wow. You can do this on alternative renewable energy projects overseas. So it was like right when you were doing this, I was going, wow. All of those factors that you just did right there, just imagine if this was an alternative renewable energy project. Geothermal, biogas, solar, utility scale solar farm. There would be other, maybe the subsidies that you would get. You might even get an upfront subsidy of $4 million from the host company, which would drop your upfront costs by about $4 million. So IRR on this, which would be interesting to take a look at. But imagine if you had a lump sum subsidy from the, I mean, they're already giving you tax shields and stuff, but imagine if they give you upfront lump sum subsidy to reduce the construction costs, what your IRRs would look like. They'd be off the charts. So obviously you're onto something, right? Going back and reevaluating the energy companies overseas and their movement away from oil. Nice job. That was really great. Could you pull up the slide and turn the lights back on for me, please? So what I would do now is pull out your exam. And if you could pull up the slide. Can you pull up the slide? Can you pull up the... And then you're missing one more bank of lights. So when you're writing the one-page brief, you know, for your global stock portfolio, you should write like a one-page brief, okay? And the one-page brief should talk about some of the things that we're going to go over here in the paper.
Do you have any like examples on Moodle about like a one-page brief for like?
I think I do. I mean, I would take a memo too. But you know, one page. I think the way that you set up the stock market thing was really good. But you know, it should be your opening pitch, right? It should be there, and then the portfolio weights, and then the risk-adjusted rate of return or the expected return on the portfolio. You know, the beta, right? The benchmark return, the alpha.
A couple graphs on like the graphs.
If that, you know, but it should be just really brief.
Okay.
But the discussion within the in the report, you should add some of the context that we're going to talk about here. Okay, because you're putting together a portfolio,
Yeah.
right, of different countries.
Of course.
The question is, why did we pick those countries? And some of those countries have certain types of attributes.
Basically, we're just laying it out.
What?
We're just laying out what we're doing
In the map right here.
yeah, basically that's
Yeah, it's basically a high level. If we were to imagine, you know, the country funds and the ETF reports that you're going to pull off. Let's say you're BlackRock or you know whoever. Let's say you're BlackRock. Those country funds. Usually, before I give a country fund to a client, our country fund to a client or a portfolio to a client, there's got to be a brief. Right? There's got to be a memo that basically says what it is, what's the portfolio. Give me some, you know, style discussions, and then give me the allocations and give me the returns, you know, and then the risk tolerance. Make it it's got to be a marketing base. It's kind of what I'm looking at. Because when the client goes through the calculations, that's really the backup material. So what I'm trying to train you is to do these briefs, you know, these memos, because you're going to be writing a ton of them, and you got to be on every single thing that you submit. Okay, so getting used to doing that's going to be important. So do you have any questions? Any other questions? Any other questions? So the paper I wrote on emerging stock markets, they're also called developing stock markets. What you're looking for when you're analyzing going into a country, especially an emerging or developing market, and theoretically, yes, there's going to be more volatility, you know, in those countries, depending on if they're emerging or developing or newly developed or, you know, industrialized countries. So when you're investing in emerging and developing economies, you're looking at economic growth paths first. You know, what is the rate of economic growth? I mean, what's India and China growing at right now? Between like 7 and 9%. What do we grow at? 2. Okay. I mean, although we're bigger, so there's more opportunities, but again, if you want that high growth exposure, you want to be going into economies that basically have the environment, the infrastructure, you know, and the institutions to be able to allow them to be able to grow at a very rapid rate for a long period of time. You have to look at the ability of the markets to capitalize. Are they bringing new companies to market? Is the stock market capitalizing over time? Is it growing over time? Is there demand for capital market instruments there? Growing middle class. Well, these are the people who have disposable income and wealth and very high savings rates. That's why the Asian markets, you know, the Asian tigers were so attractive in the 80s and the 90s, is it basically had a lot of the underlying market fundamentals in place to be able to allow those markets to capitalize very rapidly. Population and employment growth. Germany's population's not growing anymore, it's shrinking. Other industrialized country populations and employment and labor force are shrinking. Okay, even though it's really large, so there's still opportunities there, but again, you don't have young, highly skilled, highly educated workforce that's growing, that's moving into the middle class and saving and consuming. Real wage growth, again, is the monetary authorities allowing for inflation to be extremely high, which is even though the nominal growth rates and wages are high, but after you factor in inflation, their real wage growth is actually negative or zero. That's not good, okay? So you have to look at real wage growth and wealth creation. You know, is the middle class growing in wealth? Are they participating in real estate? Are they participating in the stock markets? Financial institutions. You need multiple types of financial institutions. Banking institutions, mortgage institutions, brokerage institutions, central banking institutions. You have to have institutions in place to be able to not only channel that savings into investments, but be able to coordinate and do that very effectively. So the coordination between government and market is extremely critical. And the competencies and the ability of the government to create an environment of coordination between business and government. And that's why we're going to do the business-government relations stuff, because it's really important. Currency convertibility and stability. You can't have a currency control board. You can't really have inhibiting the capital flows coming in the country. There's got to be convertibility. There's got to be enough cash, M1, M2, monetary base, to be able to allow the currency to come in. You've got to have the financial institutions that can absorb the capital flows that come in, and you need the corporations that can handle the capital flows to deploy the capital flows effectively. You need economic and political and policy stability. You need an environment of government stability, institutional stability, which will breed investor confidence and consumer confidence and business confidence. So this, I'm kind of amazed at, you know, as you kind of study this stuff, these are extremely complex industrial policies that have actually been conducted and been conducted with relative success. So we have a lot of role models or case studies or paired examples to look from. The movement from, you know, agricultural to industrialized economies, from manufactured goods to services, going from nationalized and protected industries and companies to denationalization, to publicly traded companies. You have to have an environment that promotes privatization of the government, corporations. You have to be able to bring those corporations public and securitize them. And you have to have economic liberalization, opening up of the economy and allowing them to compete on a global basis. Again, this is neo-classical or neoliberal, you know, economic, political ideology. This is what we've been brainwashed with, me especially over the last 30 years, but I'm going to stick with it because it is the accepted ideology. What you're looking for is efficiency in the capital markets, in the stock markets. You're looking for liquidity within the individual issues and the overall market, and the marketability of those securities to be able to raise capital very quickly in your own home country. You have to have the reporting in place. global audit standards and global financial reporting standards to be able to provide the transparency that foreign investors require before they go into the global market. And that's why a lot of them don't invest in the securities individually, they go through a fund, because the fund manager basically creates that layer to basically alleviate a lot of the information costs, the asymmetric information by having to do it yourself. So there's some reliance on the fund managers to provide some of that information. Efficient global capital markets or emerging capital markets. You need to set up financial intermediation. Capital markets are intermediaries from savers to investors. So you have market institutions, and then you have financial institutions such as banking institutions. Provide that financial intermediation. So you need the institutions, you need promotion of those institutions to be able to channel that capital efficiently. The ability to do the intermediation has to be at low transaction costs. You can't have a lot of friction in the transfer of the savings to investors. And again, you have to have transparency. You have to have a developed or developing legal system and a tax system, a progressive tax system, and probably a European common law legal system, as opposed to a Napoleonic or some other type of legal system, because the European legal system, particularly out of London, which was the standard, is the standard for legal decisions and private property right enforcement in these countries. So if they set up parliamentary systems along with the common law system, that usually meets the requirements for global capital to flow in. And that's pretty painful for a lot of countries to make that transition to different types of legal systems. What I don't have in here is corruption. That's a big deal too. Before you go into an emerging market, you have to underwrite the risk, particularly from a corruption standpoint. That's huge. I didn't even think about that. You need interest rate and currency rate stabilization. So you do need central banks and treasuries to be able to stabilize the currencies. You can't have volatile currencies. That just adds more risk. You can't have volatile stock markets. That just adds more risk. So you're not going to get capital accumulation if you have volatility in the currencies or in the stock market. So you need dealers, market makers on the stock market side. You need the treasury and the central bank to provide currency stabilization. And one of the ways you do that is to mitigate and reduce inflation volatility, or the inflation risk premium, the monetization of the currency, because the country may have excessive sovereign debt, and they want to monetize the debt through inflation. So those are two triggers right there. As high inflation and high debt loads. So you try to avoid countries that have that. But if they're putting in policies to stabilize interest rates and currencies and inflation, then they're moving in the right direction. And Argentina right now has just gone through that. It's a perfect example where they've stabilized the currency, they've stabilized inflation, and I think they may be setting themselves up for recovery. So that may be your bond play. And there might even be a bond play in Brazil too. Because their bonds are at 8 to 12%, and ours are at 2. So. And then financial liberalization is really the degree of sovereign leverage, okay, getting back to the bonds. Debt to GDP, total debt outstanding, inflation, those are all key factors. Government owned and operated entities. This is where I think China is the biggest opportunity. So if Trump can negotiate more liberal capital inflows and ownership of Chinese companies, particularly the government-owned companies that are underperforming and actually mismanaged. Huge opportunity for stock market capitalization. Huge inflow, even more foreign direct investment and portfolio inflows into China as they basically recapitalize their capital stock. So when I made some lectures to some government officials and some business people from China, this was the one thing that I focused on for them. I said huge opportunities if we can get liberalization and ownership, and then a denationalization of your government-owned industries. Huge wealth effect would be created in China, massive. And then monetization of the debt is a big concern because of inflation. And then adverse selection and moral hazard problems. I mean, the banking institutions, when they're lending to individuals and businesses, or when the bonds are issued, moral hazard and adverse selection issues. Moral hazard is basically, I'm gonna give them the funds from the bond issue, I'm gonna lend them the money for the loans, and then they're gonna take the money and either misappropriate or misspend it. So it's a moral hazard problem because I underwrote it under different guidelines, underwriting guidelines, but actually they were hiding some of the information. So when I made the selection to fund them, they were actually worse credit than I actually thought they were. And then that's adverse selection is the basically the borrower is lying to you and showing you better credit, and you're selecting them, which comes back to haunt you through defaults. And then moral hazard is you give them the money and they basically misspend the money or misappropriate or do something else. So the risk was also higher too. Coordination is the key. Coordination of liberalization in economic policies and macroeconomic reforms by the central bank and the governing bureaucracies. You need regulation and supervision that's consistent, that enforces the regulation and supervision to mitigate the moral hazard and adverse selection issues. You have to, the goal is wealth creation at the end of the day. Raising wealth and standard of living. That's the goal at the end of the day. And economic growth. And then being able to promote savings and investment, and again, capital formation in your underlying business stock.
Is the wealth creation goal, is that like measured like by GDP mainly?
Usually they measure it on a GDP per capita basis, which is a mismeasure because GDP is not a perfect measure of wealth, but it is a measure that they use. Okay? There may be other savings per household or total investments, I mean other metrics of wealth accumulation. Okay? Obviously on a per capita basis, would be ideal. And then public-private sector development, private sector, again, the private sector is going to get the money, and they're going to channel money into the resources. This is productive economics. International Finance Corporation is a major institution that promotes all of this stuff. So basically what they do is they do advisory, they do audit, they guide companies and review, their organizational structures and their balance sheets, their business models, and make them attractive to be able to go public and be able to raise capital. So they look at resource mobilization, the ability to allocate the resources. They look at the underlying infrastructure, the institutions. And then what they do is they make recommendations on individual security investments and issues that the company can make, either debt or equity. But they make recommendations on the types of instruments that the company may want to issue or that the governments may want to promote. Okay, because again, stock is the standard product, right? So are bonds, right? But stock, these are stock markets we're talking about. So adhering to Western security laws and legislation, so that their security contracts look just like our security contracts.
So the instruments are like options?
It could be convertible bonds, they could be convertible preferreds, they could be option contracts on existingly traded securities. Yeah. So these guys also advise in the financial market innovation. Okay. And then the database, which you may want to look at for your case study, is the emerging market database. Okay. Again, they have country funds in there, ETFs, private placements. So that's a great place to go to be able to find the data that you need to put together your portfolio. Financial institutional development, the goal is really diversification across different types of institutions. So you got leasing companies, you got insurance companies, you got investment banks, you got commercial banks, you got mortgage, banking institutions, and mortgage banks. So you have a diversification, again, to create that the intermediation across different financial institutions. So institutional diversification is extremely important to promote the markets. Privatization of state enterprises, we already talked about that. One of the ways to do it, this is kind of a balancing act, is when you eliminate price controls. be able to get the prices to go up and then have competition amongst companies to basically supply into the market to get to the, you know, marginal cost, marginal revenue point, right? Fixed costs at some point go away. But you have to eliminate price controls, and it's extremely inflationary at first. When you're restructuring economies, it happened to Russia when they went through glasnost. They lifted the price controls, and inflation went through the roof. They almost rioted, but then all of a sudden competition came in as they opened the borders and then allowed for the goods to flow in, and then prices started to come down again. So the goal is, in privatization, is rising industrial production, GDP. That's the goal, because who's producing? The companies are producing. So again, the goal is production, okay? And if the companies have a comparative advantage in agriculture, you promote that. If it's in industry or technology, you promote that, okay? And then shareholder democracy, the ability of the individual shareholders to have votes, right? To be able to vote in the board and management. So shareholder democracy usually comes from institutional investors, mutual funds and large institutional investors that invest in these companies. But you have to have input from the pension funds, the endowments, you know, from other large holders of the securities to keep everybody in check so you don't have principal agent problems. The role of foreign capital, so you open the borders, you allow the portfolio income to come in. You obviously, hopefully, have enough companies within industries, so there's enough investments to be able to absorb that capital. These foreign investors are extremely sophisticated. I mean, most of them are based out of New York, you know, in London. So these are the money center locations, are where these people are located, okay, that control the institutional funds that drive the capital into these countries. Currency conversion, you gotta be able to convert into the currency, and you gotta be able to convert out the currency. You gotta be able to repatriate your money out of the country. So currency conversion is extremely important for repatriation of your profits. And then global diversification, we all know that raises risk-adjusted rates of return, but that's really the goal of the investors. They have hurdle rates that they have to meet, but they want to be protected by the risk. Okay, so risk-adjusted returns is a focus. And then one of the biggest problems is the lack of reporting and the lack of liquidity and the lack of price stability, both in the currency, inflation, and in the stock prices. So the goal is divisibility in the shares. Again, your shares aren't trading at $20,000 a share, they're trading at $20 a share. So divisibility creates liquidity. And then those denominations and the ability to do block trading, institutional block trades, allows for transferability of the ownership, which is what you need also. And then you have to be able to do the intrinsic valuations of these securities to be able to come up with the valuations. Go ahead.
Is the transferability?
Is that still on me? Can you move that up?
Is the transferability so you don't like move the stock too much?
You have the ability to move the stock.
Okay.
So if I'm an institutional investor with 100,000 shares, I can sell that to another institutional investor and then transfer the ownership rights. So transferability in trading is really important.
But if you just sold those shares off, the stock would decline.
If you sold off institutional block trades of securities in thinly traded markets and in thinly traded securities, yes.
So like in a more, in a higher volume market like America, like if you did that, would it still decline or would it?
It depends. I mean, I can trade, 100,000 shares or even 1 million shares of Microsoft in a minute. It won't have an effect on the stock price because it's so widely held. So you need breadth and depth within these stock markets. A lot of them are thinly traded, and that's where the volatility comes in. Okay? So just looking at the developing economies compared to developed, if you look at the securitization of capital stock, in developing countries it's only 15%. In developed it's 52%, maybe even higher. So that kind of gives you an idea. You know, maybe you target these markets that are moving in this direction, right? And you're going to get capitalization. Small claims, again, nationalization. You need to have a lot of the assets don't have tradable liabilities. They're owned by large government institutions, if they're not securitized, okay? So it's not broadly held within the economy. The asset or the industrial stock is held by few institutions as opposed to broadly held by a broad array of institutional and retail investors. We have a very deep retail base here, which is very unique. I mean, we have very high securities participation rates here in the United States. And a lot of those assets are under leverage. So again, they don't have equity on them or enough, and they don't have enough debt on them either. So the market potential is huge for capitalizations. And that just limits the ability of the markets to develop. They lack a market efficiency, inefficient markets. The attributes associated with inefficient markets are high cost of capital because the information costs are so high. So your CAPM, your beta is really high, and your risk-free rates are really high, right? Financial repression. Again, you have institutions that want to continue to control these ownerships, so they repress the development of these markets. The information that does come to market comes out with long lag times, not quarterly reports or instantaneous pricing and information coming to the market, but long delays. And that creates volatility. You don't have enough market analysts. You don't have security analysts and other analysts that are monitoring the securities or monitoring the markets. It's a very thinly covered market. And then you have thin or discontinuity in the trading. The securities not trading minute by minute. They trade once a week or once a month, okay? Not minute by minute. And that just creates more price volatility. So this just begs for privatization and securitization. You need economic and stock market stability. So you gotta have coordination. Monetary fiscal policy, credit capital markets, consumers, producers, investors, all that's gotta be coordinated together. And then the prototypes, and I got 2 minutes, the examples are really the Southeast Asian tiger markets. Okay, those are the prototypes. It started in the 80s, it started to accelerate, capitalize in the 90s and into the 2000s. So those are the examples where they were fast growing, export oriented, targeted technology. They had high agricultural industry concentration. There's probably opportunities to go from agrarian to industrialized agriculture. Their comparative advantages, they had sophisticated, hardworking, and well-educated workforce, and they developed it. They had low inflation rates, high savings rates. They were an open economy that allowed for foreign capital to flow in. They had low cost and very efficient manufacturing facilities. So obviously the government promoted this and coordinated it. The disadvantages was they had political uncertainty, economic contagion. If Japan or China went down or another, Thailand went down, it contaged into the other economies. And then you had economic and stock market volatility because of the lack of liquidity, because they were emerging and capitalizing. And then lastly, they had thin stock markets and limited number of listed companies to be able to actually participate, in the capitalization.
Would you say this is America without 3 and 4?
Which one?
Like this whole tiger market, yeah.
We have a relatively well-educated workforce, but we don't have government policy that I can see in place that promotes free education. So free education would probably signal, a public good provision that would distance them from other countries. Because people can now go to school and get the skills. The other is housing, and the other is healthcare. It's expensive, but if they have all of those, then capital's going to flow in if they can mitigate these disadvantages. So Nick, will you?
Yep, go ahead.